Okay, thanks for joining me guys. Today I'm doing a scheduled non-current assets question. It's task 4 on ACCN3 June 2013, so it's a A-level question on AS level, it's second year of college. So let's get straight into it. So we've got our 3 assets, land and buildings, motor vehicles and fixtures and fittings. We're given cost, depreciation, net book values with all the totals, how the depreciation is derived each year, and then a few additional information bits to work through, which makes it a bit more complicated. So, prepare a scheduled non-current assets at the 30th of April 2013. So, always we start with the workings because you'll have no chance, especially in second year, if you can't do workings out, especially in complete records. If you can't do working out, you've basically got no chance. So, anyway, right, so we're going to start off with our land and buildings information. So, do we have any additional information about land and buildings? We do. So, land and buildings were revalued at $260,000 on the 1st of May 2012, and when did that's the end of the year. So the start of the year was the 30th of April. Hang on. Yeah, sorry, that's the start of the year, sorry. And so one day after the start of the year, we've had them revalued, so that's during this financial year. So what do we always start off with? We start off with our cost. So we've also got a revaluation. So have we bought any land and buildings or sold any, disposed of it? 1, we've revalued. 2, nope. 3, nope. 4, no. So we can go straight to our net book value. So the cost at the start of the year was $187,500. Don't know the revaluation yet, but we do know the net book value is now £260,000. So basically you've got to work out the difference of M2, which comes to $72,500. So what I'm going to do is I'm just going to put that straight. I've already done part of it because the information there is it's all given to us, all this. So brought down 187,500 is just given to us. So these 3 here correspond to these 3 here. The brought downs here, these 3, they correspond to these 3. We've just calculated that, but it's you can kind of get it anyway without doing much work. I think you only get like 1 mark for it. So and these 2 additions, we already knew them for the additional information. I didn't have to work them out in any way. I could just put them straight in without having to work it out. So back to my workings anyway. So we've now got a net book value of £260,000. So now I need to work out my depreciation for this year, the charge for the year. The charge for the year is simply the amount of depreciation that will go into the income statement. I used to think it was a lot more confusing than that, but it's simply that. That's all it is, what you'll put in your income statement. So it's really linked to ACCN1, ACCN2 stuff. So we've got so let's see how we do it. We do a straight line method at 4% per annum. So net book value, 260,000. So our charge for year is simply 260,000 times by 0.04, which gives us £10,400 worth of depreciation for this year. So now we can come back onto our, basically this is the answer sheet. Oh yeah, don't forget, I probably should have put a title. So the title is schedule. That means non-current assets. Don't do it in your exam. I'm just trying to do it as quick as possible. For PERL, PLC, as at, so it's like a balance sheet, as at 30th of April 2013. It's always worth mark the title, so make sure you get it. So I worked out my charge for the year is 10,400. Now, as I said before, we've not eliminated any on disposal, we've not sold anything, so we can't have any eliminations on disposal. So revaluation though. So it was worth, well, we were previously worth 131,250. Oh no, sorry, let me reword that, sorry. Brought down was 56,250, that's how much depreciation had already occurred to our land and buildings before this year now. However, we just had a revaluation from here, 187,500 back up to 260,000. So that depreciation is basically non-existent. It happened, but then it got completely wiped off by the revaluation. So basically, we have to cancel that depreciation out, because we can't revalue it up to 260,000 and end up knocking off the 56,250, because that hasn't happened actually. It happened and then we took it away because we had a revaluation, so we can't take away that full amount again here. So our carry down is simply going to be, well, these two cancel each other out, so it's just going to be 10,400. So the net book value is just cost here, cost carried down, take away depreciation carried down. It's very simple. Cost minus depreciation equals net book value. It's just what you learn in your first year. So I think that's right. 249,600. Yeah, that's right. Okay, I'm going to leave motor vehicles and go on to fixtures and fittings, because motor vehicles is a bit more difficult. So, fixtures and fittings, what did we have? Well, what do we have? Fixtures and fittings, the only thing for fixtures and fittings in additional information is part 4. Fixtures were purchased, so in addition, during the year at a cost of 5,200, which I've done. I've just put it in. It's as simple as that. I don't have to work anything out. We've had no disposals, no evaluation, so we can just go straight into calculating our carry time, which is going to be 5,200. Okay, now, so how are we going to work out our charge for the year? Well, once again, let's look at our policy, which is a straight line method at 15% per annum. So what I'm going to do is just work it out on here. So we'll go on to, just going to abbreviate out to fixtures and fix and fits, and so it's straight line method at 15% per annum. Right, so how are we going to calculate this? Well, we'll simply, all it's going to be is 55,200 times by 0.15. It's just cost times the depreciation policy is going to give us our charge for the year. So put in brackets charge for the year. 8,280. Okay, so it's that easy. So that's the value that would go into your income statement as the depreciation figure. It's that simple. So charge for the year 8,280. We haven't disposed of any fixtures and fittings. We can't have any elimination and disposal. We've not revalued it, so we can go straight to working out our total depreciation, which is 21,780. Once again, cost minus depreciation gives us our net book value, which I found out was 33,420. So it's quite straightforward so far. We've only had just two basic straight line method depreciations to calculate, and the revaluation of the land and buildings. The only thing you could have tripped up on really was the revaluation having to take away the depreciation, simply because we've wiped it out basically. So now we're going to move on to motor vehicles. As you can see, once again, I've just put into the depreciation the addition, which is part 2, and the cost. So basically they're all things given to you, you won't get marked for them. So motor vehicles, and this is going to take probably the majority of your time, this part of the question, because it's quite tricky. So we had an addition of 24,950. So just write that down to make sure we know what it is. Right, so we need to work out, one thing we haven't done so far is work out an elimination on disposal. But we have to in this question, because we have disposed of an asset, or a motor vehicle, in part 3. So we had a net book value of 18,450, was sold during the year for 15,500. Completely ignore that. Selling price means absolutely nothing. However, this is important. It was originally purchased on the 1st of May 2010, and also this is vital. A full year's depreciation is charged in the year of purchase, but none is charged in the year of disposal. So, what year are we in now? We're in the year of 2013. So it was disposed of in 2012. It was So the previous year. So 2010 to 2011 in May, so that's 1 year. 2011 to 2012, 2 years. 2012, 2013, yes, it was around in that year, but that's the year of disposal, so it's no depreciation. So 2 years of depreciation needs to be charged on it. So we need to work out the elimination on disposal. No, we need to work out the total amount of the disposal first of all, then we can work out how much is eliminated. So the disposal. So we're going to start off with the net book value, and we need to get this net book value back to its cost. We need to know how much cost we've lost. So we're going to times that by, okay, right, motor vehicles, reducing balance method at 25%. So if you were just doing a normal depreciation, say you had a £10,000 motor vehicle, and you had a 25% reducing balance method, you just times that by 75%, which would give you your new net book value. So we're going to do the opposite. We're going to do 100 over 75. And again. So that's its first year in our company, and that's the second year in our company. So now we can times that all together, and we're going to get 32,800. So that's the cost, that's the total disposal that we're going to put into our schedule of non-current assets. So we can put that straight in. Disposals 32,800. Everything up here is dealt with cost. There's no sort of net book value up here. It's all cost. So we didn't have any revaluation. So we're just going to total that all up, and we're going to get 104,650. Easy enough. Okay, so now this is where it gets a bit trickier. So how about we work out our elimination on disposal? Well, it sounds kind of tricky, elimination on disposal, but it's really easy. The elimination on disposal is simply how much depreciation that asset, the amount of depreciation that occurred to that asset during its lifetime. Elimination on disposal. So it's basically the elimination on disposal is basically its cost minus its net book value. That's all it is. So it's cost 32,800 minus net book value 18,450, which gives us our total depreciation figure of 14,350. So that's it. That's the elimination on disposal. 14. That's the amount of depreciation that occurred to that asset in its whole lifetime. And because we've sold it, we need to eliminate it. We don't have that depreciation in our books anymore. So 14,350. So now to calculate the charge for the year, and it's probably the trickiest part of the question, mainly because it's reducing balance, but it's not that difficult. So how are we going to calculate our charge for the year? Well, we've got our net book value in our brought down, our original brought down, 63,300, because we care about that now. It's our reducing balance. Straight line doesn't care about net book value, whereas reducing balance does. So we've got our net book value of 63,300. Okay. Now we need to add on, because we've got an addition, because we want the depreciation of everything we have. We have an addition was purchased during the year at 24,950. We want this included because we charge depreciation in the year of purchase. If it said we don't charge depreciation in the year of purchase, this wouldn't be in our equation, this addition. But also, we need to take away our disposal. And we're taking away the net book value disposal. So 18,450. And we're going to total that up to give us 69,800. Okay, so how are we going to work out the total depreciation? Well, it's quite simple. That's now our net book value. So technically we just need to times that by 0.25 to get our depreciation, because that's the policy. So all we need to do is times by 0.5. I'm going to get 17,450. So now we can slot that into our actual scheduled non-current assets. So 17,450. No revaluation because it's not land and buildings. So now we're going to get our total depreciation figure, which was 52,300. Once again, cost minus depreciation gives us our net book value, 52,350, I believe. And that's it basically. It's quite simple once you break it down. It's like all accounting, like incomplete records. Once you break it down to the T accounts, it's very simple. Cash flow statement, very simple once you break it down. But as always, email me if you've got any suggestions for future videos, any questions, and I'll see you in the next video. Thank you.